Hey, what's up, stock compounders? Brad here. So over the last couple of days, I've had a question I've been trying to get answers to. And the question is, if I look at companies over the last 10 years, so looking back 10 years, that have been able to compound at 20% per year or higher, what does it look like in terms of what industries those companies are coming from? And, are these 20% plus compounders more concentrated in certain industries than they are in other industries? So, and of course, Terry Smith, one of the things he focuses most on is return on capital employed to indicate to him how high of quality of a business am I dealing with. That's his first in his list of three. Buy great companies, don't overpay, do nothing, right? So this is really the buy great companies. Where are these great companies? What industries are they in? So here's how I approached this. I went to Ticker Terminal, which is my favorite tool to screen for companies. If you guys aren't in Ticker already, I've got a link down below in the description, so check that out. It helps the channel. So here's the screen I set up for Ticker Terminal. Industry, just display. I didn't want to remove any industries. I just wanted to be able to see what industry these companies were in. It's either in the US or it's in Canada. So I wanted to include both of those countries in the results. Over 25 million market cap, and stock price percent change over the last 10 years, more than 520%. Now that seems like kind of a random number. So 20% per year compounded over 10 years is 520%, or 6.2 times, okay? So if you start with $10 in one of these companies, you should have $62 or more after 10 years. That's what I'm looking for in this screen, companies that fit these criteria. So 293 results out of the 67,000 plus that are in Ticker Terminal's database. So what I did is I brought those companies into this spreadsheet, and I sorted by industry. Okay, I wanted to know which industries are there multiple, at least two companies that have generated 20% returns per year for the last 10 years. So I pulled those into a different sheet. But I also wanted to know Terry Smith. Terry Smith in Fundsmith has 52 companies. I wanted to know what industries is Terry Smith focused on. So what I did was I looked for industries that show up repeatedly in Fundsmith's holdings. If there was just one company in an industry in his holdings, I used a different color for that. So if there's multiple industries, I used green. Just one company in the industry, I used yellow. So let's jump over. This is kind of the results, right, of this study. So here's how I sorted this. The green are industries where Fundsmith has multiple holdings currently. The yellows are where Fundsmith has just one holding. So you can go down here. That's not how it's sorted. It's sorted by density of 20% performers, okay? So this is the number of 20% plus performers over the last 10 years in this column. And then I wanted to figure out, the number isn't good enough. I want to know, what the size of the pond is. How many businesses are currently in that industry in the US and Canada, over 25 million market cap. So I can get a sense, if I just throw a dart blindly at those companies, how often am I going to hit one of these 20% 10-year compounders? Okay, so that's the density of the 20% performers. Now, the data isn't perfect. Here's why. So ideally, I would be looking at how many companies were there in these industries 10 years ago, right? Because that's when I would have been making these investments in these 6.2 baggers at the beginning, right? 10 years ago. So that would have given me much better numbers if I could know what was the size of the pond 10 years ago. I don't know how to get that information. So I figure, all right, what's the size of the pond today? It's not going to be perfect, but I think it's going to be directionally correct. That's an assumption that I'm making. So, I mean, this is incredible. Semiconductors and semiconductor equipment as an industry in ticker, almost 24% density of these 20+% performers over the last 10 years. That's incredible. So that was pretty fascinating to see. And this is how it's sorted by density. So the second highest density was road and rail. 6 out of 46 hit that magic number of compounding at 20% per year for the last decade. So you can see a 13% density. Beverages, air freight and logistics, healthcare, equipment and supplies. These are all very high. So if you just throw a dart at all industries, you're going to hit one of these 20% plus performers 4.3% of the time. Now that's excluding capital markets. The reason I excluded capital markets is because most of these are ETFs, right? They're not businesses, they're not operating businesses. Okay, they're financial products. So I just got rid of that sector when I came up with these numbers for number of performers and kind of total universe of companies. 4.3%. Now, if all you do is decide, okay, I'm only going to shop in 6 industries for investment ideas. It's kind of a combination of which have the most density and which Terry Smith shops in, right? Our favorite growth investor. So beverages, healthcare equipment and supplies, professional services, life sciences, tools and services, electronic equipment, instruments and components, and software. If I only look at those 6 industries, so I pull these numbers in this column and this column over to here, 68 hits, okay? 20+% performers over the last decade out of a total pool of 794 companies. I just doubled my hit rate on these 20% performers, okay? Versus looking at all industries. So that's pretty compelling. Fish where the fish are. There's clearly a concentration of fish in these top 15 industries or so. Now, obviously, circle of competence matters here. If you don't know these industries and you really know some of these industries, this might not be such a compelling information to get you to switch. But if you're just getting started, or if you're considering running a purely kind of quant approach to investing, like the magic formula, or like Tobias Carlyle's, what is his? It's not the magic formula. The acquirer's multiple. If you're looking to just run some kind of quant approach, it may be worthwhile to limit your industries to what have outperformed here, where the density of great performers has been over the last 10 years. Obviously, that's assuming it's going to be similar over the next 10 years. But Terry Smith, he always brings up this chart. In most of his annual meetings, he brings up this table with return on invested capital by industry. And he shows that through time, these companies and their ranking in return on invested capital aren't really changing, okay? So, the tobacco industry, looking back, has had a very high return on invested capital, at least the median company in there. And he's found that that's fairly consistent through time. Industries with higher ROICs tend to remain so, at least over the amount of time that Terry Smith has studied this. And this is from a research report put out by Michael Mauboussin. It's all about return on invested capital. Great report. 44 pages long, from Morgan Stanley. So, this is exactly highlighting what I'm trying to solve here, which is which industries are really worth fishing in to get this great performance in the portfolio. And, if you're fishing in ponds where the return on invested capital is significantly higher than other ponds, it just makes it that much easier to achieve these very impressive returns over time. Why did I pick 20%? A lot of people do say like a 10 bagger in 10 years kind of thing. I picked 20% because that's essentially what Berkshire Hathaway has done since 1965. Okay, so that's already a very high bar. That's double the performance of the market over that time, since 1965. The S&P has done just shy of 10%, I believe. And so I figure, double what the market is doing over the long term, it's a very aggressive rate of return. But it's not insane, right? I think it's actually achievable. Clearly it's achievable because Warren Buffett has done it, even in a lot of the later years when they've been constrained by how much assets they've had. Fat wallet is the enemy of high returns, as the saying goes. So certainly some of these highlighted industries are industries I'm going to be paying more attention to when I run screens. I'm probably going to prioritize these industries, mainly the ones up here that are highlighted in green. So I've got one other thing I wanted to show you guys. I really wanted something that went back further than 10 years. Okay, 10 years doesn't feel like a whole lot of time. For someone getting started with investing, having a 50, 60, 70 year runway, 10 years, it's not that long. The incredible performance really comes in when you can find one of these great companies and let it compound over multiple decades. Okay, I was just looking at Walmart since I think 1972. 1970 or 1972 is when Walmart went public. And if you look at the returns, I don't think anybody has held Walmart for that long other than the Walton family. But it's just incredible, the impact that compounding can have on a business that just gets, better and better, which are obviously very rare. Here are 18 businesses. This is how much they've compounded. They've all compounded 20% or higher over the last 30 years, okay? And so this is something I got from Macro Trends. It was really hard to find a tool that I could use to come up with a list like this over more than 10 years looking back. But this was 30 years. And certainly some familiar names here, but names also that aren't familiar. And I wanted to know what industries are showing up here, right? With these companies that have just continued to crush it for 3 decades in a row. Is there going to be a concentration of industries? So that's the quick exercise, pulling together these list of 18 companies. Now I'm going to sort by industry, just so we can see, if there are any duplicates. It'll make it easier to see that. Now, out of these 18 companies, there's only 3 industries that repeat, okay? Biotechnology for Biogen and Gilead Sciences, Cooper and IDEX, healthcare equipment and supplies, and then Diodes and KLA Corp, semiconductors and semiconductor equipment. Now, we remember this semiconductor and semiconductor equipment from here. That was the top performing industry, okay? 23 of these outperformers with a universe of 98, okay? Pretty ridiculous. So that one certainly showed up in this kind of 30-year study of compounding at 20% or greater per year. But there's a lot of industries represented, right? There's 18, there's 15 different industries represented here with only 3 that repeat. So, obviously these great companies can come really from any industry. But I do think this is a worthwhile exercise, seeing what's the concentration of these outperformers. What industries, really produce some of these outperformers, partially as a result of just having higher return on invested capital, return on capital employed as a whole within the industry. So I just thought this was kind of an interesting rabbit hole to go down. I'm going to attach the spreadsheet in the description so you guys can take a closer look at the data, make tweaks as you see fit. So that was the rabbit hole I went down today. Just want to see if there's anything else. That was all I wanted to share, guys. So hopefully you guys enjoyed that. Maybe it's useful. Let me know in the comments if it is. And I will see you all in the next one. Take care.